Most investors think making money in the stock market is all about luck. You pick the right stock, wait a few years, and hope it goes up. But professional investors, the ones who manage billions, do not rely on luck. They rely on something called factors. Factors are the secret codes behind market performance. They are the DNA of investing. And once you understand them, you will start to see the market in a completely new way. So today, we're breaking down factor investing, what it is, how it works, and how you can use it to build long-term wealth. Let's start simple. Imagine every stock has certain traits. Just like people have height, weight, and personality, stocks have characteristics like size, value, momentum, volatility, and quality. These characteristics, or factors, determine how a stock behaves over time. Some grow faster. Some are more stable. Some outperform in good markets. Others shine during recessions. Now, instead of guessing which company will win, factor investing allows you to invest based on patterns that have historically produced higher returns. It's not about predicting the next Apple. It's about identifying traits that successful stocks tend to share. Think of it like betting on a horse. Instead of choosing a random one, you look for the factors that usually predict winners. Speed, stamina, track record, and conditions. That's exactly what factor investing does. It's smart, data-driven, and based on decades of research. The idea of factors started in the 1960s. Economists noticed something strange. Some groups of stocks consistently outperformed others over long periods. Eugene Fama and Kenneth French, two legendary financial researchers, developed what became known as the Fama-French model, which explained stock returns using three main factors: market, size, and value. Since then, many more factors have been discovered. But 5 have stood the test of time. These are the pillars of factor investing. Let's explore them one by one. The first is value. This factor focuses on buying stocks that are cheap relative to their fundamentals. Things like low price to earnings or price to book ratios. It's the principle behind Warren Buffett's philosophy. Buy good businesses at fair prices. The idea is that undervalued stocks tend to outperform over time, because eventually, the market realizes their true worth. When everyone else is chasing hype, value investors quietly buy the forgotten, overlooked companies. And history shows, patience usually pays. The second factor is size. This is the small cap versus large cap effect. Smaller companies tend to outperform bigger ones over the long run. Why? Because small businesses have more room to grow. They're nimble, innovative, and often undiscovered. Large corporations like Apple or Microsoft are stable, but they won't grow tenfold easily. Small caps, on the other hand, are like hidden gems. Riskier, yes, but with explosive potential. That's why size is a key factor. It captures the power of growth through agility. The third factor is momentum. This one sounds almost too simple. It says that stocks that have gone up recently are more likely to keep going up in the short term. It's like surfing a wave. You don't fight it, you ride it. Momentum exists because of human behavior. People chase performance. When a stock starts rising, more investors notice it. They buy in, and that pushes prices even higher, creating a self-reinforcing cycle. Momentum investing isn't about luck. It's about psychology and knowing when to ride trends without getting caught in reversals. The fourth factor is quality. High-quality companies consistently make profits, have low debt, and strong management. They might not be the flashiest stocks, but they survive tough times better than most. In recessions, quality stocks act like anchors, keeping your portfolio stable when everything else is sinking. Investors love quality because it represents reliability. It's the kind of business that can compound wealth for decades. The fifth factor is low volatility. It might sound counterintuitive, but research shows that less volatile stocks, the ones that don't move wildly up and down, often deliver better long-term returns than the high-risk ones. That's because consistency compounds. A steady 10% return year after year beats a roller coaster of 30% gains and 20% losses. Low volatility is the secret weapon for conservative investors. Who wants growth without sleepless nights? So those are the 5 classic factors: value, size, momentum, quality, and low volatility. But the beauty of factor investing is how you can mix them. For example, some investors build portfolios that combine value and quality, buying strong companies that are temporarily undervalued. Others prefer momentum and low volatility, riding winners while keeping risk under control. It's like cooking. Each factor is an ingredient. You mix them based on your taste, goals, and risk tolerance. Now you might be wondering, how do you actually invest in factors? You don't need to be a Wall Street analyst. Today, it is easier than ever. There are ETFs, exchange-traded funds, that focus on specific factors. For example, you can buy an ETF for value stocks, or small caps, or momentum-driven companies. You can even buy multi-factor exchange-traded funds. That automatically balances across different factors for you. This makes factor investing accessible for everyone, not just hedge funds or professionals. Let's take an example. Suppose you invest $10,000 into a simple multi-factor exchange-traded fund. It allocates across small cap, value, and quality factors. Over 20 years, that portfolio could significantly outperform a plain S&P 500 index fund. Not because it is riskier, but because it is smarter. It's based on how markets actually behave, not just random guesses. And that's the heart of factor investing. It is evidence-based. Every strategy is backed by decades of academic research and historical data. Now, let's talk about why it works. Factor investing works because human behavior does not change. We are emotional. We overreact to news. We chase fads. We panic during downturns. Factors exploit these consistent behavioral patterns. For example, the value factor works because investors tend to ignore boring stocks. The momentum factor works because investors chase trends. The low volatility factor works because people underestimate the power of stability. Each factor exists because of a mix of risk and psychology. And as long as humans trade, these factors will keep appearing. But let's be real. Factor investing isn't perfect. There are risks. Sometimes factors underperform for years. For example, value stocks struggled for almost a decade during the 2010s because investors were obsessed with growth and tech. Momentum can crash suddenly when trends reverse. Small caps can get hit hard during recessions. That's why diversification across factors is so important. You don't marry one factor. You build a balanced portfolio that combines multiple strengths. Think of it like a basketball team. You don't just need shooters. You need defense, passing, speed, and teamwork. Each factor plays a different role. Together, they create resilience. Now, you might ask, how do I choose which factors to focus on? It depends on your personality and goals. If you like buying bargains and holding for the long term, you will probably love value and quality factors. If you're comfortable with short-term movements, momentum could fit your style. If you want safety and consistent returns, low volatility might be best. And if you are young and can handle risk, size or small cap investing could bring higher rewards over time. The key is to stay consistent. Factors don't work all the time, but they work over time. Discipline beats prediction. Let's put this into perspective. Imagine two investors, Sarah and Mike. Sarah invests in a mix of value and quality exchange-traded funds. She is patient and rebalances once a year. Mike tries to time the market. He buys whatever is trending, crypto, meme stocks, you name it. After 20 years, Sarah might not have the most exciting portfolio, but her returns are steady, compounding year after year. Mike, on the other hand, has wild swings, stress, and inconsistent results. That's the difference between speculation and systematic investing. Factor investing is systematic. It removes emotion. It replaces guesswork with structure. It's how professionals invest, quietly, methodically, and with conviction. Another advantage of factor investing is transparency. You always know why your portfolio looks the way it does. If you are underperforming one year, you can identify which factor is lagging and understand whether it is temporary or structural. That's a luxury most investors never have, because most people don't even know what is driving their performance. Factor investors do. They understand what is happening under the hood, and that knowledge builds confidence. Confidence to stay invested during downturns. Confidence to avoid emotional decisions. Confidence to play the long game. Now, here's something powerful to remember. You can use factors beyond stocks. They apply to bonds, real estate, and even crypto. For example, in bonds, you can use factors like duration and credit quality. In real estate, you can apply value and momentum. In crypto, you can analyze volatility and network growth. Factor thinking changes how you see every asset class. It gives you a framework, a way to understand risk and opportunity scientifically. And that's what makes it so powerful. Instead of chasing hot tips, you build portfolios based on evidence and probability. Now, let's talk about what's happening in 2025. AI and machine learning are making factor investing smarter. New tools can analyze massive amounts of data to discover hidden factors no human could detect. For example, AI-driven models can identify behavioral signals, like sentiment or social media trends, that influence stock performance. This is the next evolution. Quantitative factor investing enhanced by AI. But the core idea remains the same. Understand what drives returns, and invest based on those drivers. Whether it's 1980 or 2025, the principle doesn't change. Because markets evolve, but human behavior stays the same. Now, let us simplify it into action steps you can follow. Step 1. Learn the factors. Understand what each one represents and how it behaves. Step 2. Choose your approach. You can buy individual factor exchange-traded funds or a diversified multi-factor fund. Step 3. Commit for the long term. Factors take time to work. Short-term volatility doesn't mean failure. Step 4. Rebalance annually. Review your portfolio and keep your factor weights aligned with your goals. Step 5. Stay patient. Even the best factor strategies go through dry spells. Trust the process. That's how wealth is built. Through discipline, not drama. Now you understand why top investors love this approach. It's simple, scalable, and rooted in reality. Factor investing isn't about chasing the next big thing. It's about building a system that works quietly behind the scenes, growing your money while you sleep. It is how you turn investing from gambling into science. So the next time someone tells you, the market is unpredictable, smile because you know better. You know there's a pattern beneath the chaos. You know what drives performance. And most importantly, you know how to use it to your advantage. That's the power of factor investing. It's not flashy. It's not hype. It's simply smart. If you stay patient, stick to your plan, and let the factors do their work, you'll be far ahead of the crowd chasing luck. Because in the long run, systems beat emotions, logic beats noise, and factors beat feelings. That's how smart money plays the game. Quietly, efficiently, and profitably. So start small, learn, apply, and watch your investing confidence transform. Because once you understand factor investing, you'll never look at the market the same way again.